In finance, a futures contract is a standardized forward contract which can be easily traded between parties other than the two initial parties to the contract. The parties initially agree to buy and sell an asset for a price agreed upon today, with delivery and payment occurring at a future point. The delivery date, because it is a function of an underlying asset. A futures contract is a derivative product. Contracts are negotiated at futures exchanges, which act as a marketplace between buyers and sellers. The buyer of a contract is said to be long position holder, and the selling party is said to be short position holder, as both parties risk their counterparty walking away if the price goes against them. The contract may involve both parties lodging a margin of the value of the contract with a mutually trusted third party. For example, in gold futures trading, the margin varies between 2% and 20% depending on the volatility of the spot market. The first futures contracts were negotiated for agricultural commodities, and later for natural resources such as oil. Financial futures were introduced in 1972, and in recent decades, currency futures, interest rate futures and stock market index futures have played an increasingly large role in the overall futures markets. The original use of futures contracts was to mitigate the risk of price or exchange rate movements by allowing parties to fix prices or rates in advance for future transactions. This could be advantageous when a party expects to receive payment in foreign currency in the future, and wishes to guard against an unfavorable movement of the currency in the interval before payment is received. However, futures contracts also offer opportunities for speculation in that a trader who predicts that the price of an asset will move in a particular direction can contract to buy or sell it in the future at a price which will yield a profit. Origin: the first futures exchange market was the Dojima rice exchange in Japan in the 1730s, to meet the needs of samurai who, being paid in rice, and after a series of bad harvests, needed a stable conversion to coin. The Chicago Board of Trade listed the first ever standardized, exchange-traded, forward contracts in 1864, which were called futures contracts. This contract was based on grain trading, and started a trend that saw contracts created on a number of different commodities as well as a number of futures exchanges set up in countries around the world. By 1875, cotton futures were being traded in Bombay in India, and within a few years this had expanded to futures on edible oilseeds complex, raw jute and jute goods and bullion. The 1972 creation of the International Monetary Market, the world's first financial futures exchange, launched currency futures. In 1976, the IMM added interest rate futures on U.S. Treasury bills, and in 1982 they added stock market index futures. Risk mitigation. Although futures contracts are oriented towards a future time point, their main purpose is to mitigate risk of default by either party in the intervening period. In this vein, the futures exchange requires both parties to put up initial cash, or a performance bond, known as the margin. Margins, sometimes set as a percentage of the value of the futures contract, must be maintained throughout the life of the contract to guarantee the agreement, as over this time the price of the contract can vary as a function of supply and demand, causing one side of the exchange to lose money at the expense of the other. To mitigate the risk of default, the product is marked to market on a daily basis, where the difference between the initial agreed-upon price and the actual daily futures price is re-evaluated daily. This is sometimes known as the variation margin, where the futures exchange will draw money out of the losing party's margin account and put it into that of the other party, ensuring the correct loss or profit is reflected daily. If the margin account goes below a certain value set by the exchange, then a margin call is made and the account owner must replenish the margin account. This process is known as marking to market. Thus on the delivery date, the amount exchanged is not the specified price on the contract but the spot value. Upon marketing, the strike price is often reached and creates lots of income for the caller. Margin. To minimize credit risk to the exchange, traders must post a margin or a performance bond, typically 5% to 15% of the contract's value. Unlike use of the term margin in equities, this performance bond is not a partial payment used to purchase a security, but simply a good faith deposit held to cover the day-to-day obligations of maintaining the position. To minimize counterparty risk to traders, trades executed on regulated futures exchanges are guaranteed by a clearing house. The clearing house becomes the buyer to each seller, and the seller to each buyer, so that in the event of a counterparty default, the clearer assumes the risk of loss. This enables traders to transact without performing due diligence on their counterparty. Margin requirements are waived or reduced in some cases for hedgers who have physical ownership of the covered commodity or spread traders who have offsetting contracts balancing the position. Clearing margin are financial safeguards to ensure that companies or corporations perform on their customers' open futures and options contracts. Clearing margins are distinct from customer margins that individual buyers and sellers of futures and options contracts are required to deposit with brokers. Customer margin within the futures industry. Financial guarantees required of both buyers and sellers of futures contracts and sellers of options contracts to ensure fulfillment of contract obligations. Futures commission merchants are responsible for overseeing customer margin accounts. Margins are determined on the basis of market risk and contract value, also referred to as performance bond margin. Initial margin is the equity required to initiate a futures position. This is a type of performance bond. The maximum exposure is not limited to the amount of the initial margin. However, the initial margin requirement is calculated based on the maximum estimated change in contract value within a trading day. Initial margin is set by the exchange. If a position involves an exchange-traded product, the amount or percentage of initial margin is set by the exchange concerned. In case of loss or if the value of the initial margin is being eroded, the broker will make a margin call in order to restore the amount of initial margin available. Often referred to as variation margin, margin called for this reason is usually done on a daily basis. However, in times of high volatility, a broker can make a margin call or calls intraday. Calls for margin are usually expected to be paid and received on the same day. If not, the broker has the right to close sufficient positions to meet the amount called by way of margin. After the position is closed out, the client is liable for any resulting deficit in the client's account. Some U.S. exchanges also use the term maintenance margin, which in effect defines by how much the value of the initial margin can reduce before a margin call is made. However, most non-U.S. brokers only use the term initial margin and variation margin. The initial margin requirement is established by the futures exchange. In contrast to other securities, initial margin, a futures account is marked to market daily. If the margin drops below the margin maintenance requirement established by the exchange listing the futures, a margin call will be issued to bring the account back up to the required level. Maintenance margin, a set minimum margin per outstanding futures contract that a customer must maintain in their margin account. Margin equity ratio is a term used by speculators, representing the amount of their trading capital that is being held as margin at any particular time. The low margin requirements of futures result in substantial leverage of the investment. However, the exchanges require a minimum amount that varies depending on the contract and the trader. The broker may set the requirement higher, but may not set it lower. A trader, of course, can set it above that, if he does not want to be subject to margin calls. Performance bond margin, the amount of money deposited by both a buyer and seller of a futures contract or an options seller to ensure performance of the term of the contract. Margin in commodities is not a payment of equity or down payment on the commodity itself, but rather it is a security deposit. Return on margin is often used to judge performance because it represents the gain or loss compared to the exchange's perceived risk as reflected in required margin. ROM may be calculated. The annualized ROM is equal to -1. For example, if a trader earns 10% on margin in 2 months, that would be about 77% annualized. Settlement: physical versus cash-settled futures. Settlement is the act of consummating the contract, and can be done in one of two ways, as specified per type of futures contract. Physical delivery: the amount specified of the underlying asset of the contract is delivered by the seller of the contract to the exchange, and by the exchange to the buyers of the contract. Physical delivery is common with commodities and bonds. In practice, it occurs only on a minority of contracts. Most are cancelled out by purchasing a covering position, that is, buying a contract to cancel out an earlier sale, or selling a contract to liquidate an earlier purchase. The NYMEX crude futures contract uses this method of settlement upon expiration. Cash settlement: a cash payment is made based on the underlying reference rate, such as a short-term interest rate index such as 90-day T-bills, or the closing value of a stock market index. The parties settle by paying, receiving the loss, gain related to the contract in cash where the contract expires. Cash-settled futures are those that, as a practical matter, could not be settled by delivery of the referenced item. For example, it would be impossible to deliver an index. A futures contract might also opt to settle against an index based on trade in a related spot market. Wikrent futures use this method. Expiry is the time and the day that a particular delivery month of a futures contract stops trading, as well as the final settlement price for that contract. For many equity index and interest rate future contracts, this happens on the third Friday of certain trading months. On this day the T+1 futures contract becomes the T futures contract. For example, for most CME and CBOT contracts, at the expiration of the December contract, the March futures become the nearest contract. This is an exciting time for arbitrage desks, which try to make quick profits during the short period during which the underlying cash price and the futures price sometimes struggle to converge. At this moment, the futures and the underlying assets so extremely liquid, and any disparity between an index and an underlying asset is quickly traded by arbitrageurs. At this moment also, the increase in volume is caused by traders rolling over positions to the next contract or, in the case of equity index futures, purchasing underlying components of those indexes to hedge against current index positions. On the expiry date, a European equity arbitrage trading desk in London or Frankfurt will see positions expire in as many as 8 major markets almost every half an hour. Pricing: when the deliverable asset exists in plentiful supply, or may be freely created, then the price of a futures contract is determined via arbitrage arguments. This is typical for stock index futures, treasury bond futures, and futures on physical commodities when they are in supply. However, when the deliverable commodity is not in plentiful supply or when it does not yet exist, for example on crops before the harvest or on euro-dollar futures or federal funds rate futures, the futures price cannot be fixed by arbitrage. In this scenario there is only one force setting the price, which is simple supply and demand for the asset in the future, as expressed by supply and demand for the futures contract. Arbitrage arguments apply when the deliverable asset exists in plentiful supply, or may be freely created. Here, the forward price represents the expected future value of the underlying discounted at the risk-free rate, as any deviation from the theoretical price will afford investors a riskless profit opportunity and should be arbitraged away. We define the forward price to be the strike case such that the contract has zero value at the present time. Assuming interest rates are constant, the forward price of the futures is equal to the forward price of the forward contract with the same strike and maturity. It is also the same if the underlying asset is uncorrelated with interest rates. Otherwise, the difference between the forward price on the futures and forward price on the asset is proportional to the covariance between the underlying asset price and interest rates. For example, a futures on a zero-coupon bond will have a futures price lower than the forward price. This is called the futures convexity correction. Thus, assuming constant rates for a simple, non-dividend paying asset, or, with continuous compounding, this relationship may be modified for storage costs, dividends, dividend yields, and convenience yields. In a perfect market, the relationship between futures and spot prices depends only on the above variables. In practice, there are various market imperfections that prevent complete arbitrage. Thus, the futures price in fact varies within arbitrage boundaries around the theoretical price. Pricing via expectation. When the deliverable commodity is not in plentiful supply, rational pricing cannot be applied, as the arbitrage mechanism is not applicable. Here the price of the futures is determined by today's supply and demand for the underlying asset in the future. In a deep and liquid market, supply and demand would be expected to balance out at a price which represents an unbiased expectation of the future price of the actual asset and so be given by the simple relationship. By contrast, in a shallow and a liquid market, or in a market in which large quantities of the deliverable asset have been deliberately withheld from market participants, the market clearing price for the futures may still represent the balance between supply and demand, but the relationship between this price and the expected future price of the asset can break down. Relationship between arbitrage arguments and expectation. The expectation-based relationship will also hold in a no-arbitrage setting when we take expectations with respect to the risk-neutral probability. In other words, a futures price is martingale with respect to the risk-neutral probability. With this pricing rule, a speculator is expected to break even when the futures market fairly prices the deliverable commodity. Contango and backwardation. The situation where the price of a commodity for future delivery is higher than the spot price, or where a far future delivery price is higher than a nearer future delivery, is known as contango. The reverse, where the price of a commodity for future delivery is lower than the spot price, or where a far future delivery price is lower than a nearer future delivery, is known as backwardation.